Have you ever just stared at a stock chart with all its zigs and zags and wondered, how does anyone make sense of that chaos? Well, today, we're going to pull back the curtain. We're going to dissect a single trade from start to finish and see exactly how an analyst hunts for order and all that financial noise. Let's get into it. I mean, that's the big question, right? You look at a price chart, and most of the time, it just looks like a completely random, jagged line. So how does an analyst find a real, actionable signal in there to decide, okay, now's the time to buy, or now's the time to sell? That is the puzzle we are here to solve. So this is where we're headed. At first glance, this chart looks, well, it looks like a mess, right? It's cluttered with lines, shapes, all sorts of indicators. But for an analyst, this isn't just noise. It's a story. It's a case being built piece by piece. Our job today is to take this apart and see how it all comes together. Okay, so every investigation has to start somewhere. For a technical analyst, that starting point is usually the hunt for a recognizable shape, that very first clue that an opportunity might be taking form. So we start with a totally clean slate. Before a single line gets drawn, the first step is just to watch. You watch the rhythm of the market, the pulse, as it creates these peaks and valleys, these highs and lows. These are the fundamental building blocks of everything that comes next. And out of that rhythm, we start to create structure. An analyst will identify the most important peaks and valleys, we call them swing points, and then basically connect the dots. You can see them labeled here, X, A, B, C, and D. This is the very first step in turning that random motion into something that has a recognizable geometry. And boom, once you connect those dots, a shape emerges from the noise. This particular formation is known as a harmonic pattern. Its name? A bearish butterfly, mostly because of its wing-like shape. But that first word, bearish, is the real clue. It tells the analyst that they should now be looking for the price to go down. So what in the world is a harmonic pattern? Well, you can think of it like market geometry. It's a specific shape built not on random chance, but on mathematical ratios that come from the Fibonacci sequence. The whole idea is that these geometric patterns show up again and again in all kinds of markets, and they can help pinpoint where the price might be about to turn around. But here's the thing. One clue is never enough to act on. A professional analysis is a lot like a detective building a case. You need multiple, independent pieces of evidence that all point to the very same conclusion. So now, the hunt for that extra evidence begins. And this leads us to probably the most important concept in this whole process, confluence. Confluence is the idea that the absolute best, most reliable setups happen when different, totally independent tools all line up to point to the exact same price zone. It's a powerful intersection of evidence. It's like having 3 different witnesses all tell you the exact same story. And this shows that idea perfectly. Look at the left, there's our bearish butterfly pattern, all on its own. Now, on the right, you can see the analyst has layered on a second tool, a second piece of evidence. We're starting to build the case. And that second tool is called a Fibonacci retracement. It's based on these wild mathematical ratios that were discovered way back in the 13th century. Analysts use it to project these invisible price ceilings and floors on the chart, levels where the market is likely to react. And there it is, the aha moment. This is the confluence. Look at how point D of our butterfly pattern, its completion point, lands exactly inside that red box, which is a key resistance zone identified by that Fibonacci tool. 2 completely different methods are now screaming about the very same price level. This is what gets an analyst to sit up and pay very, very close attention. So the case is built. All the evidence points to a specific spot on the map. But a pro doesn't act yet. Nope, now they wait. They wait for one last piece of the puzzle. See, everything up to this point has just been a theory, a hypothesis. The theory is that the price should turn around here. So the analyst just watches that circled area, patiently waiting for the market itself to prove the theory right with what's called a trigger. And there it is, that long red candle. That's the trigger. You can think of it as a snapshot of a battle between buyers and sellers. And this candle shows that at this critical level, the sellers came in with overwhelming force and slammed the price down. The sellers have won the battle. That's the final confirmation. It's only now, with that final trigger in hand, that a trade plan is actually formed. And notice how incredibly precise this is. There's a clear entry point,
a stop loss that defines exactly how much money is at risk if the idea is wrong, and a target where the analyst plans to take their profits. No guesswork. Now, this single number, you could argue this is the most important part of the entire plan.
This is the risk-to-reward ratio. And what it means is simple. For every $1 the analyst is willing to lose on this trade, the plan is targeting over $5 in potential profit. This asymmetry is the absolute bedrock of professional risk management. It means you can be wrong, and you will be wrong, but you can still be incredibly profitable over time.
So let's zoom out for a second and look at the big picture here. It's so easy to just focus on whether this one trade made money or lost money. But honestly, that's kind of missing the whole point. And yeah, in this case, the analysis was spot on. After that trigger, the sellers stayed in control and the price fell, heading right down toward that profit target. It was a successful trade. But the real lesson here isn't about this one win. The best analysts on the planet know they're going to have losing trades. That's just part of the game. The goal isn't to be a perfect fortune teller. The goal is to have a structured, disciplined, repeatable process that gives you an edge over the long haul. And that whole anatomy of a trade we just walked through, it really boils down to this simple 4-step playbook. 1. Find a high probability pattern. 2. Confirm it with confluence from other tools. 3. Wait patiently for a clear trigger from the market itself. And 4. The most important step of all, define your risk and manage your plan with unshakable discipline. Which really leaves us with one final question to think about. After seeing how all these pieces fit together, is technical analysis really a science that predicts the future, like some kind of crystal ball? Or is it more of an art form, a disciplined process for managing probabilities in a world that's fundamentally uncertain? Something to think about.